Hello, fellow Rebel Capitals. Hope you're well. So, everyone remembers the yen carry trade blow up from just a few weeks ago. But unfortunately, we haven't heard the last of the yen carry trade. Let's go right over to Zero Hedge, and I'll show you guys what I'm referring to. The Japanese central bank, the BOJ, just came out with huge news about their interest rate policy moving forward. Remember, they've been in a rate hiking cycle, if you want to call it that, which led to this whole Japanese yen blow up because the yen appreciated against the dollar and unwound a lot of that carry trade. Let's get right over to Zero Hedge and check out what's going on now. So, yen craters as Japan gives up on further rate hikes. Carry trade is back with a bang. So what's going on here is everyone in the marketplace believed the BOJ that they were going to continue to hike rates. They were going to normalize rates. But if you guys remember I've said this a few times on the channel, where the last time I was in St. Bart's, actually the time prior, I apologize. The time prior, I was talking to my good buddy Steve, who has been one of the top hedge fund managers. He's retired, but was one of the top hedge fund managers for 40 years. In fact, he started in Japan in the late 1980s. And this is right about when the yen was about 160 and the Ministry of Finance came in and intervened in the market to try to get the yen to appreciate because it was declining rapidly against the dollar. And that's when the central bank also started to take interest rates up. And when I mean up, I mean from like 10 negative or 10 negative 10 basis points up to like positive 10 basis points. Not really up that much. But they started this rate hiking cycle, if you want to call it that, which makes the yen appreciate. And that's what blew up the yen carry trade. But I was asking Steve, I was like, in your experience over 40 years with emerging markets and seeing the Japanese do this and all of this intervention by the central planners to try to manipulate the currency, how many times has it worked? And he laughed at me and he said, it never works. It never works. He goes, this is the way it'll play out. He goes, the central planners always come in and try to do something to combat what's happening with the currency. And it'll work for a couple months, and then it'll just revert right back to where it was before. And inevitably, eventually, the central planners will lose and the market forces will win. He goes, that's how it plays out every single time. And I said, okay, so what's the bottom line? He goes, bottom line, yen's going to 200. that's exactly what he said. He goes, yen's going to 200. There's no way they're going to be able to continue these policies. They're going to have to back off. The market's going to win. So it's funny to see this kind of playing out because this is exactly how Steve said it would play out. But getting back to the article here. So let's just go back in time and revisit what happened. Recall that for years on end, the BOJ and the government were doing everything in their power to crush the Japanese currency in hopes of sparking inflation. Because remember this? I mean, in fact, you guys remember prior to COVID, the central planners in the United States were doing the exact same thing. Remember, that was our big bugaboo in 2012, 13, 14. Oh my gosh, it's deflation. We have to remember the whole 2% target was not to get inflation down to that target. It was to get inflation up to the target. Remember that? And that wasn't that long ago. And this is what Japan was doing as well. That deflation was the enemy. Deflation. Scary. We've got to raise consumer prices because somehow that'll fix everything. All right. So getting back to the article. So the country, they're talking about Japan, was stuck in a deflationary debt trap, seemed like the only possible exit from its existential implosion was they're talking about devaluing the yen. But then the yen did crater to a 40-year low. That's when I was talking to Steve, and it was at 160, and they were trying to intervene to bring it down, which they did, obviously. Japan scrambled to do the opposite and intervened in the open market on multiple occasions to contain further selling of the currency, as the resulting inflation led to devastated standards of living and sparked outrage among local population. So they finally got the inflation they had been trying to create over the last 20 years. And they're like, whoa, sorry. I guess that wasn't such a good policy. I guess people don't like it when they have to spend more and more and more of their paycheck just to get the same amount of stuff every single month. Who would have known? Who could have guessed? So then they backpedal, but in the process, I guess this really shook up the government, which is what Zero Hedge talks about next. So they say sparked outrage among the local population over runaway inflation. I don't know if I call it runaway inflation. Inflation got up to like 2%, but I guess for Japan, that's runaway. Eventually resulting in the collapse of the Kishida government, which is, they say, what they warned about last June. So here is just the real wages. I mean, if you think real wages are bad in the United States, look at what they've done here in Japan. So you can see this blue line is nominal wage growth. Oh, shoot, that takes us to Twitter. Don't want to do that. Okay, so this blue line is nominal wage growth. So the politicians, I'm sure, were saying, oh, look at this, how amazing it is. Wages are growing, wages are growing, wages are growing. But then it's like, yeah, but they're not going up at the same rate of inflation. So what really matters is your purchasing power, which is represented by this red line in Japan. And you can see that has gone straight down. Getting back to Zero Hedge. But it was only when the BOJ decided to shock the market with a surprise second rate hike in July, even as the rest of the world was aggressively cutting rates, that the yen soared. So the Ministry of Finance intervenes. They probably sold dollars into the market, bought yen in order to make the yen appreciate from 160. So then it goes from, let's just say, 160 to 150. But then the central bank comes in and says, yeah, we're going to go on a rate hiking cycle. Just so you guys watch. We're going to normalize interest rates. And everyone's like, oh my gosh, the BOJ, they've done a complete 180. They're now going to fight inflation, and they're going to take interest rates up to 3 or 4%. And so then the yen strengthens on the news and goes to, let's say, 140. And then, as Zero Hedge points out, that's when all the yen shorts were annihilated. And it's not the people that were just short the currency. It's people that were short the currency by and through the yen carry trade. So they are borrowing yen over here at very low interest rates. They are taking the yen, turning that into dollars, and then they're taking those dollars and they're buying U.S. assets, as an example. I mean, just look at the spread. Let's assume the spread between what they're borrowing at 5 basis points, and then let's say they have to pay a couple percent to transfer those yen into dollars. Okay, fine. But then what happens is they're being paid, let's say, 5% on a treasury. Okay, great. We're pocketing the spread. And what seems to be very low risk, until the yen strengthens. And then what happens is that makes the burden of your debt increase to a point where you can't pay it. Therefore, you have to sell the asset to pay off the debt before you get underwater, a margin call, if you will. And so this is what led to now I just use treasuries as an example, but a better example would probably be even riskier assets such as CLOs, just stocks, the NASDAQ, etc. The problem with this, of course, is that not only did the Nikkei crater, forcing the BOJ to immediately come out and defend the wealth effect. But then stocks in the United States obviously got just pummeled as well. But I want to point out before moving further, guys, is it's not just the yen appreciating, which forces those people that took advantage of the yen carry trade to sell their US assets. It would also be a result of those assets going down. So you've got two pressure points there. You've got 2 points of substantial risk that would prompt that margin call, which would create this unwind, right? Now, what I want to do is I want to, oh, first, this is hilarious. Check out this chart. So this is when this is basically the BOJ, and I don't know if I've even told you the punchline here, but the BOJ came out and said, yep, sorry, we're not increasing interest rates anymore. We've done enough. We've done enough. Our rate hiking cycle is over. And so a few weeks ago when they were saying, real hawkish, oh, we're going to take rates up to 1%, 2%, 3%, just you watch, we're going to normalize. Now, just like my buddy Steve predicted, they come out and say, well, actually, yeah, that normalizing thing, yeah, we don't really see a need for that anymore. So we're going to go ahead and stop the rate hiking cycle. You say, wow, George, that was how high did they get with this rate hiking cycle? Right here, Zero Hedge points out that they got up to a whopping 25 basis points. That is one hell of a cycle. I don't know if I'd call that a cycle or a blip. I think it's more of a rate hiking blip before they go back down to inevitably what will be probably negative, which will take that yen straight up to 200, maybe, who knows, maybe even higher. But now let's get over to kind of some dynamics between or behind the yen carry trade. Go over to Investopedia, because if the central bank has come out and said, okay, the rate hiking cycle is over, what does that mean? That means that the risk of the yen appreciating further or creating an environment where all those speculators, let's say, were completely off sides, the probability of that is very low and has decreased massively. So one would expect that all the speculators see this, they've called the BOJ's bluff, and now that they have, what are they going to do? They're going to take that yen carry trade, and it's going to go on to hyperdrive. Because now they can't increase rates. They can't do it. And if they can't increase rates, then that eliminates one of your risk pressure points. So if you were borrowing $1 billion, let's say a few months ago, now, whoo, bye, as Jim Cramer would say. You're going to back up the leverage Brinks truck. You're going to take that trade from $1 billion. Hell, you're going to take it up to 10 billion. Because now you have almost zero downside with the yen as it pertains to the Bank of Japan increasing rates. So then you got to think, okay, well, if now the yen carry trade is going to go into hyperdrive, then what does that mean for U.S. risk assets? We're going to answer that question, or I'll give you my base case here in a moment. But just as a review, carry trade, borrowing at low interest rates and investing the proceeds in an asset that provides a higher rate of return. Borrowing yen, U.S. stocks, let's say. But look at this chart. This is what I wanted to highlight. The pink shaded area is, or I guess you want to call it the purple line, we'll say, at the top. And the shaded area is the delta between that and the light blue line. That's U.S. interest rates. So this goes back to kind of what Brent talks about all the time with his dollar milkshake theory, that the United States likely can keep interest rates higher. Not that they can keep them high, but they can keep them higher than places like Japan and Europe. And we can see this really play out. There's a great visual with this chart. Back in Volcker days, When the United States took rates up to 16%, Japan only took them up to 7.2. And you could see every single time the United States has increased rates, if the BOJ has done the same, they haven't done it to the same degree, not even close. And a lot of times when the Fed is in a quote unquote rate hiking cycle, the BOJ continues to drop rates even further. I mean, look at the GFC or prior to it. Greenspan took rates from, call it 1% in the United States, all the way up to 5% before everything blew up then, while the BOJ took rates from a whopping 0.1% up to 80 basis points. And what's crazy is they could at least get them up to 80 basis points back then. Now, they can't even get them higher than 25 basis points. While the United States still has the ability to take rates up to 5.25. So again, if I'm a speculator, if I'm a trader, if I'm like a Paul Tudor Jones type or a Stan Druckenmiller type, I'm looking at this and I'm licking my chops. I'm saying, okay, now the gig is up with the BOJ. They have shown me their cards, and their cards show they're done. They're done. All this talk about rate hikes, it's all BS. And if anything, they're going to have to reverse course. So I am going to go to my bank and I'm going to say, how many trillions of yen can I borrow to buy U.S. assets? That's official. That officially started today. Today. Assuming that's when the BOJ made this announcement. Let me make sure. Because what we need to do, guys, is we need to track when the BOJ made this announcement and then what U.S. assets do over the next couple weeks. Because if, let's just say they respond positively and we see a huge uptick in U.S. risk assets, then there's a high probability that this is a result, or the yen carry trade was at least a tailwind to what is happening with risk assets in the United States. That's very important, very important. Okay, I'm just scanning this article, guys, to try to figure out when they said it. Assuming it was today. Yeah. I mean, so this came out this morning at 9:30, and this is actually, let me do this. Let me just Google Bank of Japan, and then we'll look at the news from today. No rush to rate now. They're keeping them steady. Nope, zero hedges on top of it. This must have been something that they came out and reported just this morning. I wish they would link to the Reuters press release or something like that that shows. Or maybe this is based on some of their statements. But the bottom line here is this most likely this news came out either yesterday or today. So over the next 2 weeks, we're going to have to see how this impacts markets. And what I'm going to do once this video is over is I'm going to try to figure out how we can monitor how much yen is being borrowed and see. We got to talk to Jeff about that, Josh. You got to give us some insider information from Jeff, because I'm sure he has a trick of knowing to what degree the yen carry trade is being put on. And so my point there is, let's just assume that the NASDAQ goes up by 10% in the next couple weeks. Well, if no news has changed based on my last video, the narrative hasn't changed, then, and let's just say that the amount of yen being borrowed has skyrocketed and the charts look the same, we can assume that that correlation might be a result of causation. And then you say, okay, well, if the yen continues to plummet, then the yen carry trade is going to continue to increase, which perversely is likely going to give a tailwind to the stock market becoming even more of a bubble than it already is. All right, guys. Enjoy the rest of your afternoon. As always, make sure that you're standing up for freedom, liberty, free market capitalism. We'll see you in the next video.